Your Money in Business starts now.
Good evening and welcome to Your Money in Business. I'm Jeff Salkin. We begin this week with big changes in the world of 401k investing. Joining us is Tom Reese, consulting actuary and partner at Conrad Siegel Actuaries. Tom, thanks for being with us.
Thanks for having me today.
401ks are important for a lot of people, but let's take a minute to explain why. This is the major sort of retirement plan that most employers are offering these days.
That's correct. You know, back in the day, it used to be everyone had a defined benefit plan, but now 401ks are the primary source of retirement. And this gives employees the ability to withdraw monies out of their paycheck to lower their taxes, put monies in on a pre-tax basis, and they can invest those monies and it can grow for their retirement.
The employer often offers a match of up to maybe 5%?
Well, it could be any percentage. In these days where employers have been starting to pull back a little bit on their matches, or actually they're starting to reintroduce it, but back in 2008 we saw a number take it away. But a match is another excellent way that employees can grow their nest egg, because by putting in some of your own money, employers will put in a piece as well, be it the matching contribution.
So this is a very important thing that had been somewhat opaque for investors in it, about fees in particular, but that's changing with some new government regulations. What's happening?
Well, there's a couple things going on. The Department of Labor came out with 2 new regulations this year, effective this year, and one's more focused on the employees, one is focused on the employer. We're basically just trying to make sure that both the employer understands the fees being charged, and then ultimately the employee understands truly what fees are coming out of their account.
From an employee perspective, what are they going to see?
Well, employees are going to see really 2 things. One is they've actually already received it, but they may haven't noticed it. As of the end of August, they received a disclosure that lists all the different investments in their retirement account, and it shows the fees that are with respect to each one of those investments. And the disclosure shows a percentage that's coming out of each fund, and it's a hypothetical dollar amount that comes out based on that percentage. So employees should have seen that. Secondly, effective September 30th of this year, with their next statement they're going to get, they're going to actually see if there's any fees coming out of their account being charged by, being passed on by the employer. That dollar amount will be reflected on the statement.
How does the employee know whether these fees are reasonable fees?
Well, employee, well, that's a good question, because there's really no benchmark, no information out there available. When they're looking at their fees, quite honestly, the lion's share of the fees are coming out of the investments, out of their account, that the disclosure they already should have received.
They're still paying it.
That's right. And that general rule of thumb that if you have expenses or the fee coming out of the investments in your funds is 1.5% or greater, that should raise some eyebrows. That's something that you may want to ask your employer about, is have you looked into see if are these fees reasonable or not?
Most employees may get a blizzard of paperwork on this stuff, and may be experts in whatever they do for a living, but not on the financial side, and potentially inclined to just put it in the drawer and forget about it. Why should they pay attention to this?
Well, it's going to have a big impact on their nest egg. Fees have a significant impact. A fee as much as an additional 1% over 25 years will have a negative 26% impact on their account, basically reduce their account by a quarter. So it's very, very important that they look at those fees, because that will ultimately eat away at the growth of their retirement account.
You mentioned there's a separate set of regulations affecting employers, or parallel regulations. What's happening there?
Well, those regulations were effective July 1, where employers should have received disclosures from their providers showing what the fees that they're being charged and what services are those different providers giving to the plan. And employers, should have received all that information and evaluate it, but then there's also a responsibility to determine, are those fees reasonable or not? And ultimately, especially if fees are being passed on to the employees, are those fees being fair and reasonable what they're being charged to their employees?
The employer has what's called a fiduciary responsibility here.
Yes.
How do they carry that out? How do they protect themselves against any potential liability?
Well, they need to basically figure out, are their fees reasonable? And there's really 2 approaches. They could put their plan out to bid, put out an RFP, request for proposal, and get information back from different providers. There's also some public information out there available, different studies showing what fees are for similar type plans, that they could do some sort of benchmarking and comparison.
What do you expect the reaction to be in the mutual fund industry, the industry that handles all of these investments? In other words, now that everything's going to be out in the open, will there be pressure on fees that potentially could lower fees over time?
I think there's going to be some pressure. I think there's going to be some downward movement in the fees in the plan. I think in particular it's more with respect to investment products, investment options. You're going to see where there's investments that have very high fees. There's going to be pressure and negotiation by employers to reduce those fees. So I think it's just with the exposure of these fees, we're going to see it's going to benefit the employees ultimately. They may not see that at the outset, but over time I think they're going to see that because the investments will have lower fees.
How often do companies actually change plans? Sounds like a big headache.
It is a big headache, and that's employers do not like to deal with it unless they're dealing with a great deal of pain. In the past, they probably looked at their retirement plan closely, maybe once every 5 years, if even that. But I think these new regulations are going to require or force employers to look at least on an annual basis, and certainly more often than they did in the past.
You've been involved in this area for years. You've seen how employers and employees deal with their money. I'm curious what sort of mistakes you see people making in trying to save for retirement.
There's a number of different mistakes. Probably, I think of the young person, the person that's just out of college, getting into the workforce. They didn't think for them to get started in the 401k plan, they'd rather have that money out of their paycheck today and spend it versus putting a little bit aside to grow it for their retirement and not taking advantage of compound interest. Perhaps
or maybe they need to spend it. I mean, they have expenses.
That's right.
Maybe make the case for somebody why they should think hard about not doing a 401k.
Well, they should not be. Well, certainly if they want to take advantage of compound interest, if their employer is putting in a matching contribution, that's free money on the table that they're missing out on, and depending on how generous that match is. But with the match, with the ability of compound interest, that's a sizable amount of money that will be for you available to you when you're at your future versus your needs right now. And I know times are tough right now, but if they can just put away at least a little bit, they'll be very pleasantly surprised what that'll grow to in the future for them.
What about in terms of choosing the actual investments in the fund, in the 401k account?
Yeah, I tend to see that employees don't always make the best choice because employees, quite honestly, are not equipped. They don't have the background, the experience. They're looking for someone to help them. So it's important for them to reach out to somebody to try to help them. We've seen a shift in the industry to try to come up with more simple products for employees to invest in to take advantage of diversification and asset allocation, some ways to be better invested for retirement.
One of those that's gotten popular is called life cycle type funds. There are different names for it, but they are designed to change over time depending on your age bracket. How do you feel about those?
Well, the target, I think you're talking about target retirement date funds they're based on some date in the future when you're planning to retire. You invest monies today that's invested more in stocks and higher risk investments, but as you get closer and closer to retirement, it moves towards a more conservative type investments, be bonds or money market. And there's good and bad with it. I like the idea that it's a simple approach. Employees are diversified. Their money is moving over time more conservatively, which is a good thing. But the key thing about target retirement date funds is they're not all the same. You could have two 2030 target retirement date funds, but one could be much more riskier as compared to another. So
different companies, fund families might have different approaches to it.
Yeah, and it's exact. They both have a different philosophy about how aggressively you should be invested as you move on the way to retirement. So it's very important so that the employee understands or has access to understand how much risk is involved in this fund.
So bottom line for employees is spend some time looking at this stuff.
Absolutely.
Look at your fees, look at your investments.
That's right. Yeah, don't be bashful. Ask questions and try to find out.
Very good. Tom Rees of Conrad Siegel Actuaries, thank you for being with us.
Thanks for having me today.